Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Sorry I'm a little bit late. I guess I took too long to eat. But we are having some non-farms payrolls here. Oops, hold on. I've got the speakers on and turn them off. So we got U.S. initial jobless claims significantly higher than the expectation at 242,000 versus 221. We also get the GDP estimate, which is coming in line with estimates at 2.3%. Continuing jobless claims slightly less than expected. We were expecting 1.8705 versus a previous reading of 1869, and we got 1862. So we actually had so this is very interesting. The thing that I find the most interesting about the job market right now is how well I can see what's going on just from like what I can see on LinkedIn and talking to other candidates and things like that. So like I have a friend that he had been out of work for I think almost 8 months, and he was posting that he had a job yesterday. So like it seems to me that hiring was kind of frozen, that there weren't a lot of companies hiring last quarter of last year, and it kind of took a month for them to like get the budget and to start hiring people. But that now here in February, they have started hiring new people. And meanwhile, they're laying off a ton of people in government. So like what you're seeing is the continued jobless claims is coming down because some of those people that in tech that have been having such a hard time getting hired have actually been hired in the last week. But you're getting a huge influx of people being laid off from government. And the issue kind of is that the reason the job market has looked pretty okay over the past year or whatever has been because the government is creating all of these jobs. And that's kind of a problem because basically you're hiding the underlying economic weakness that makes the Federal Reserve keep interest rates high. And then because interest rates are high, that strangles private business, and the tech companies aren't able to hire as much as they need to get us out of this situation, right? So I think we're in for an interesting ride over the next year in particular. I think it's going to be a bumpy ride. I'm not predicting it in a recession, but I think it's going to be a bumpy ride because there's kind of some imbalances that have to deflate, right? Okay, so I'm getting Fed speaker right now. We got Barkin. Later we got Schmidt and Barr speaking. We also got pending home sales a little bit later. Still pretty weak, light week in that respect. Let's come over before we do anything else and check the longer term charts. So here is the treasuries. Later in the session, you know, we had an auction and everything. The auction looked pretty good and treasuries were higher, but they're kind of on the downturn now. So, S&P 500, you can see here, it was a difficult start. They recovered a lot of it. Now overnight they've recovered the rest of it. Oil may be bouncing a little bit here this morning. Gold and silver. Gold still is kind of struggling and looking like maybe they want to break the line and test the downside here. And silver also still kind of underperforming. Copper has had wild back and forth because Trump is talking about tariffs and so forth relating to copper. The Japanese yen, it's still up there, just holding that range. And Bitcoin, well, yesterday there was an extension of the selling in Bitcoin. Oh, it's so funny to watch the Bitcoiners, like, when things happen. Okay, so I'm having a little bit of data issue this morning. Like, that's wrong. That bar is wrong. And it's like missing a section of data. If I come in here and I reload all historical data again, I may just be hosed. Yeah. It's just hosed. I don't know. I guess there's nothing I can really do about it. Let's turn on our algorithm anyways. See what it does with it. Oh, that's worse. So for some reason, my data provider isn't providing me the historical data correctly. Let's turn it on anyways. Okay, how were your interviews? Did I say I was having interviews? I guess I did say that I had a busy day, didn't I? I did say that I had a busy day. But you know what? I don't think I ever really know. In my career, it was the interviews that I thought I did the worst on that they were like the most excited and wanted me. So I don't know. There is one company I've been interviewing for that, like normally when I interview, it's like super exhausting and I'm just so spent by the end of it and I can't do anything else that day. But there's these one guys that I'm talking to that for some reason I feel energized afterwards. So maybe that's a good thing? I don't know. We'll see. Overall, it seems like the job market is a lot better. I'm very hopeful that I will be able to find a job in the next month before my unemployment runs out. The market conditions seem to be turning around at just the right time. Let's hope that the weakness that we're seeing in the stock market doesn't turn around and cut down the job market again before we find a place, huh? Okay, so, well, that looks correct to me. I just don't know what the deal is with this other chart where I'm getting this one bar that is clearly wrong. Very clearly wrong, but whatever. No, what we'll have to do to like filter it out or something. Oh, is Barkin that's speaking? Oh yeah, it is Barkin. Okay, cool. What else we got going on? Economic partnership with Ukraine does not include specific guarantee of funding for future warfighting. I'm supposed to get the Epstein list today. That should be... Oh, come back over here. Why didn't I come back over here? That should be interesting, huh? Let's see what Zero Hedge says about the jobless claims. The number of Americans filing for jobless benefits for the first time jumped from 220 to 242 last week, the highest since October 2024. The impact of Doge punches DC workers in the face. Oh wow, that's a pretty dramatic rise there. Yes, okay. Continuing jobless claims continue to tread water around 3-year highs. Given the number of lawsuits desperately trying to slow/delay the firing of government workers, and we use that term loosely, we would expect to see the number of initial claims in DC and therefore the nation accelerate further in coming weeks as judges are forced to allow Trump and Musk to do what we the people asked them to do. And that's all Zero Hedge has to say about it. Uzi is on that list, and Uzi says I didn't do it. It's gonna be a thing, man. I feel like that some people think that there's gonna be something on the list that will just be so earth-shattering that it will change our conception of the world, or some nonsense like that. I don't think that that's going to happen. But what I do think is going to happen is there are going to be oh wow, what's going on here in the dollar? Oil is moving a lot relative to this, and the treasuries aren't moving as much yet. So it feels like that they're not sure what's happening. But it does kind of make me think that it could be like more of a geopolitical headline. Look at the dollar just skyrocketing up there. And the S&P 500 is falling. Something happened. Okay, Mexico and Canada tariffs have been moved back to March 4th. Yesterday he said it was going to be April, and now he's saying it's going to be March. Normally I would just be like buy ZN, but for some reason I'm a little bit wary about it. Okay. See, the way that the treasuries are reacting to this kind of has me a little bit. I think that the right trade is to go long the treasuries, but it's not acting right. Do you know of a reputable prop firm lately? There have been many negative reviews about Top Step Trade. Really? Top Step Trader not paying out? Well, you know what, Anastefa? I can see both sides. Okay. On one hand, the combines are going to have rules, and that is going to mean that there are going to be instances of people that think that they should be paid out and aren't, and that might not be fair. And my experience and just watching the industry overall has been that that the most trustworthy of them is Top Step Trader. But at the same time, what I also see is that a lot of these funding companies really truly are genuine, that they really think that they're running a good business and that they're helping people, and they just don't seem to realize that there is a fundamental conflict of interest between the funded trader firm and the traders that they're funding. And so it's going to come out in a certain way, one way or another. And so the end reality is even as genuine as they're trying to be, even as, even as good as they're trying to be for you, they're still going to harm you, I think. And I still feel that it's a much better setup to trade your own account, and that if you don't have a lot of money, or you're not really a big risk taker like myself, that you can trade micro treasury yield futures and only risk $10 at a time. Just trade your own min. Okay, now they're saying something about the UK. It seems that so far my instinct on ZN and not trying to trade that headline as something that's just going to keep trending was correct. They have pulled back all the way. I guess I'm a little bit also skeptical. Like, what is it that they want Canada and Mexico to do in the next week that they're not doing? And why did they change their minds? I don't know. Or maybe it's just Trump trying to be intentionally chaotic, right? Because your negotiating position kind of improves if your opponent doesn't know what you're going to do. So if your opponent thinks that you're chaotic, then it improves your position, and maybe he's just doing that. I don't know. After the news, well, so are you talking about like the 8 o'clock news that we have, like pending home sales change? Because pending home sales change is not a super significant data point. I think that the most dominant flows that we're going to start to get here now are going to be end of month flows. And the way that things have gone through this month, I'm really not sure how those flows are going. I think that it may be that they have to sell. Oh, after the unemployment claims? Well, so it seems to me that the unemployment claims were negative overall for the markets, although it didn't seem to result in the treasuries or the interest rates coming down. So that was kind of that was a little bit mixed, I feel. But of course, now we are getting the tariff news. So I'm not entirely sure how this goes. I tell you what, the one thing that like really sticks out to me right now is that the dollar moved 30 cents. The dollar is up 30 cents now. And Donald Trump does not like that the dollar is so strong. Like, there is talk of a Mar-a-Lago Accord where all of the countries come together and makes some, just kind of like the Bretton Woods Agreement or whatever it was. Or maybe I've got it mixed up with some other event, but basically in the 80s, like all of the countries kind of got together and made an agreement to try and bring the value of the dollar down, right? So that the only really super clear move that we're getting off of this, I mean, the S&P 500 is sold, but I'm still uncertain how big of a deal it is in the S&P 500. It's just getting started over there, right? But the dollar clearly moved and moved in a direction that is the opposite of what the administration wants. Is a very curious thing. It's a very, very curious thing. I guess you're going to see the value of the Mexican peso drop and the value of the Canadian dollar drop. And so in response to that, you're going to see the value of the dollar go up. But I guess the takeaway should be that we're in a very complicated and dynamic system that might make some of the short-term moves, especially for us in the treasuries, difficult to predict. It's just, that's a situation where I hear a piece of information, I immediately have in my mind some expectation about what I think that the future flows are going to be. And I immediately, I looked at the DOM, and what I was seeing on the DOM did not reflect the flows that I expected. So I'm hands off right now. Now, we have end of month flows, and then the other thing is the NVIDIA results. Some people's kind of suggesting that the NVIDIA results were good, and that we should continue the rally. Robert Malone says calling chickens to stop bird flu isn't working. I don't know if that's... Thing is the bird flu thing has been going on for a while now. Maybe you kind of just have to let the chickens let it happen so that they build resistance, right? Oh, I'm coming through the Discord and looking at things, and I'm noticing that like my spam blocking bots and filters and everything are getting so good that there's all these people I need to ban and didn't notice. There's some other guy trying to post a video before he's even participated. I would be like, that's okay. You have to participate first. We'll see if he does. Makes me think of, that thing we had yesterday where it was like, we had somebody that had kind of been trolling us for a few days, and then eventually they did relent and be like, well, yeah, because I do have a signal service. They were trying to sell a signal service, and then it was like, oh, okay, now we can get rid of him, right? And I was thinking about that yesterday, and I see why people try to do those things. Like audience stealing is certainly a thing in the day trading space, but two things. One, this is probably the worst audience to try and pull that kind of shit. But then second of all, like I really think in the long run that you trying to utilize those tactics are just going to work against you, right? Because what you've done is you've acquired an audience, if it worked, which I don't think that it would work very well, but if it did work, you would be acquiring an audience on the basis of not having integrity, right? Which means the audience that you're going to get isn't going to be a very quality audience, and is likely to turn around and stab you in the back at the first opportunity, because I've seen many people throughout the years come in and try and do things like audience stealing and lying to people and things like that, and it doesn't work out for them in the long run. The whole like being a narcissist thing, that seems to work out in the long run, but I'm not entirely sure why that works. It was so weird. There was a thread yesterday about ICT on Reddit, basically saying this guy was never profitable, and going into like his baby pips thing. Oh, I should do that. Let's see if I can find that super long. Oh, where's my? Use this one. So now we're getting more fed up from Schmidt. Yeah, we're getting the comments from Schmidt, his speech. I don't have it. Okay, well, we'll add it in here. Let's try and find it. My simple Google search is not finding it. I might be quiet while I try and do some searching here. Okay. Yep, this is it right here. Oh, or I could just do it like this. The downfall. This right here. Let's see if I give it. There we go. Now I've got it saved in my notes, so I will never have a problem finding it again. Anyways, I was seeing this thread on Reddit, on the r/day trading subreddit about ICT, and it was one of the first times that I saw a lot of the comments that have kind of always been what I thought, in that, like, there's a bunch of people that really seem to believe in it, and there's a bunch of people that really don't believe in it. But the people that really don't believe it are like, how does anybody stand listening to this guy? Why would anybody believe this guy? Is just absolutely crazy bonkers stuff, right? But I think I know why people believe him, because you can make if you just take on a lot of risk, you can make decent amounts of money in the short term, and people can't seem to differentiate between making money from random noise and making money from a real edge. They only care that they made money, and once you've done that, it's like there's no way you can ever convince them otherwise. It doesn't work. So another funny thing along those lines was there was Thomas posted a video the other day. I really like this Thomas guy. It's like Delta Trend Trading or something. I forget what his TikTok name is. But this is a guy that, like, he went to an Ivy League school and got like a quant education at an Ivy League school. But I don't know why he didn't go into the industry. But for some reason he didn't go into the industry. And he posted a video where he had basically used Python to create a fake chart of NQ. He created a fake chart of NQ and then was like, okay, so what do you think is going to happen? Is it going to buy or sell? Right? Do you see like a liquidity grab here, or what's it going to do next? Right? And then he pointed out, well, but actually this chart is completely random. Like, I just made it up. But the thing that was funny about it was that, like, as he was showing it, I could immediately tell that it was a fake chart. Like, his general point is correct. Intraday action is largely noise. And trying to predict the next price movement based on the past price action is a fool's game. But there are some kind of like behaviors that are like, you know, the market being statistically efficient or statistically inefficient in certain situations that we know that the market experiences that you don't see in his data set. And so it's like immediately obvious to me, if you know those things, that it's a fake chart. Like, the first thing that I noticed was he had volume underneath, and the volume was just completely random, right? Whereas volume in markets usually is clustered, right? There's going to be one bar that has like the most volume in it, and then the bars that are, you know, that are close to that in terms of volume are also going to be close to that in terms of time. So it clusters, right? That was the first one. But then it was also like the chart just didn't have wicks and stuff like that. So like I could tell it was funny. There's no doubt that price is delivered algorithmically. I mean, I don't. So there are a lot of algorithms trading the market. I don't think that that means that price is delivered algorithmically, though, right? I think that that's a bad way of putting it. But the key insight that I think that if you're going to day trade, that you really need to understand if you're even going to begin to start, is that on short time frames, price is extremely statistically efficient. That is to say that it is extremely difficult to find a way to analyze the past price movement in order to make a profitable trade. And if there was some way of doing it, if there was some consistent way of doing it, then somebody would have found it by now, and we'd be studying about that. But it doesn't work that way. The market is a dynamic system that reacts to every order, and as you trade it, it moves the market and removes the inefficiency from the market. So any inefficiency that you do find, you're going to remove by trading it, and that's how the market becomes so statistically efficient. Yeah, what does delivering price even... Yeah, it's kind of like... that kind of sounds to me like terminology that you got from somebody else, but, you know, that sounds good to them and their audience, but I don't know if that really makes any sense. Delivering price to my monitor. So Ishimoku says Jim Simons. Well, so Jim Simons, he talks about there are statistical inefficiencies in the market, right? But he doesn't really go into what they are. If you go into the ones that we know of, then you kind of find that there are a lot of statistical inefficiencies in the market. You just don't see them in short-term intraday price, right? Like markets do have a propensity to trend, especially commodity markets, or at least commodity markets used to have a strong tendency to trend, but only over very, very long time periods, like days, weeks, months. Not on a 1-minute chart. To say that lower time frames are less reliable than longer term charts, it is basically it's basically what the data says, man. Do you think that I just make this shit up? If you go and you do the research, you look at the empirical research, markets are extremely efficient on short time frames, but on very, very long time frames, there is, or at least used to be, a propensity for markets to trend. It is. See, all of the technical analysis people, probably the reason why Big Pun thinks that that's a ridiculous thing to say, is because technical analysis, one of the kind of founding principles of technical analysis is that the market is like a fractal in nature. And so everything that you can see and do on a 1-minute chart, you should be able to see and do on a 1-day chart. But it's not true. It's just straight up false. It's really easy to disprove. I've had some people kind of like try and argue with me about this, but this one is very, very easy to deal with. If you're showing me a chart of price and volume, I can very quickly tell you if it's a daily chart or a 1-minute chart. The easiest way that you can tell that is that there is kind of like seasonality to it, or what would we call it? Period. You know, like the most volume happens at the beginning and the end of the session, right? So you're going to see that right away on an intraday chart. It's not the exact same. Well, okay, it is quantized differently. Okay. So let me explain to you why this is the case. Because we actually understand why, and it's really interesting. So I'm gonna have to pull my pen over here. I'm gonna try writing it. So there is a very, very well-known and well-proven behavior in order flow called the square root law of meta order impact. And this is probably the most empirically proven behavior in all of markets, aside from perhaps volatility clustering. Okay. So if you're a big institution and you need to buy a ton of something, and you say, I'm going to buy X amount. So we're going to say the impact of an order of size Q equals what? Well, so then we come in and we say that we traded 10,000 contracts, let's say. So we had the impact of 10K, and that equals X, or that equals Y. Let's say that equals Y. We measured it, right? We measured it, and the impact was Y ticks. So then you would ask yourself, what is the impact of 20K? Well, it's twice as much volume. Shouldn't it be twice as much movement? So shouldn't it be 2Y? Well, it turns out that it's not. Turns out that it's not. Turns out that it's more like 1.4142168. It's the square root of 2. It's the square root of 2. Okay, so why is that? So there's actually a formula. So the impact of an order of size Q is equal to Y, which is a scalar unique to that instrument, but consistent over time, which is if you had all of the other variables and you calculated Y, and then you came back a month from now and you did it again, Y would still be pretty close to the same, okay? Y omega, which is the volatility of the instrument, times the square root of the size of the meta order over the volume during the period. Okay. So if you have all of the data to compute Y, and when I worked at Goldman Sachs, we had a database where every time that an order was executed, we, after the fact, calculated Y, and basically they had this whole thing to tell us what Y was going to be, right? Once we know Y and we know like what the current volatility of the market is and the current volume of the market is, we can calculate the impact that the size of this order will be relatively accurately. And this is how a lot of algorithms that work on dark trading pools work, is that, you know, the market maker on the dark pool will say, okay, this is how much you want to trade. This is how much it would move the price. So this is the price that we're going to quote you, right? Or block trading desks. That's what a block trading desk does, is they have more advanced versions of this formula to calculate the impact on the market, and then they quote to the customer price based on that. Okay. This is like very strongly empirically proven. Market practitioners rely on this very, very heavily. Okay. But it kind of is not what you would expect. You would expect it to be linear, right? So what does that actually look like when you graph it out? When you graph it out, it looks like this, right? You familiar with this, with the graph of a square root, right? I mean, it goes off to infinity. It does, but there's kind of like this practical upper limit, right? In order to get above that limit, you would have to have so many contracts that there'd be like more than atoms in the universe, sort of a thing, very quickly, right? Because it's the square root law. So what that means is that the impact that you can have on the market in any one day is capped, essentially. Now, there is this thing where it's like, if you get too big, then there is like a huge, and it kind of goes like this. And that's when like the market makers are like, I'm fed up with this, and like the market just completely disconnects and goes crazy, right? But if you're executing a big order, you don't want to do that. You definitely don't want to do that, right? So there is a practical upper limit on how much impact you can have in a day. which is actually a really good thing for large institutions, right? It's a very good thing for large institutions. But for you, the day trader, it's kind of a problem. Because what do you want? You want to have this distribution. You want to have, here's a distribution, and I want most of my trades to be winners and slightly less to be losers. And then I want this super long right tail, right? Where, when it does work, it really, really works, and I can make a ton. And there might be some data point like way, way out here where I make so much that even if I lost every other time, this one time would make it worth it, right? You want to do that, right? Well, because the market can only move so far in a day, if you're day trading, that is to say that you have to close your position at the end of every day. That caps this. That caps this, right? And the whole thing is that this tail right here is where the profits from momentum strategies come from. Okay, so when you go on to a higher time frame and you're able to hold the position for months and months at a time, that's then when you're able to get a winner that's so large out here on the distribution curve that it makes all of the math work out. But if you don't have that, if you have to close it at the end of the day, then the math just doesn't work out and a momentum strategy doesn't work. And that is why momentum strategies work on higher time frames but do not work on intraday data. Does that make sense? Don't be autistic, just bring up two charts, a 1 minute and a 1 day chart, and zoom out on both and crop out the y-axis and ask the audience which one is which. Yeah. Price delivery is institutional. Yeah, okay. This does sound like ICT nonsense. Empirically proven by whose standards? Okay, okay. My goodness. I see a lot of people say kind of silly things to me when we're talking about this stuff, but that one like really takes the cake. Okay. So what does empirical mean? Do you even understand what empirical means? So empirical means like proven by experience, which is to say that like I can explain to you the thing. I can tell you that objects fall at 9.8, like the force of gravity is 9.8 meters per second or whatever it is, right? And you can go and you can drop things off of a roof. You can measure how high your building is and then drop things off of the roof and measure how long it takes for them to hit the ground. And you can predict how long it's going to take to hit the ground pretty accurately, right? And if I give you all of Newton's laws and all of the formulas and everything, you can do your own experimentation and verify that the results of your experimentation match the model that I've given you, match Newton's equations, right? So that's what we mean by empirical. Like you can go and you can look at any data set you want and verify it on that data set. Okay. So this square root law has even been shown to exist in the cryptocurrency markets. Mt. Gox gave a researcher every transaction that happened on the exchange over a multiple month period. And they then went through and they were able to look at any time that a really big player was doing something, they were able to identify 1 million meta orders. They tested it over 1 million meta orders and showed that this stylized behavior held, that the market tends to react to a large meta order in a square root law, a square root with relation to the size of the order, right? This is probably one of the most researched, like peer-reviewed journals. If you go to school, if you go to an Ivy League school or any school where they're teaching quant stuff about markets, they will teach you about this. For some reason, retail traders don't care about it. They don't understand why it's relevant to them, or maybe it's just over their head. I don't know, but anybody that's like doing research in markets, in the professional world, in the academic world, know about this. Okay, like questioning this is foolish. It's foolish. It's just as foolish as questioning Newton's laws of gravity. Okay. Yeah. Experience, that could be anything. Yeah, because so the opposite, that's kind of funny, because that's just like what the base of the word means is like by experience. But what they mean by that is that I don't have to take your word for it. That I can take your model and I can go and verify it myself against the real world is what they mean, right? So probably like the opposite of that would be like anecdotal, right? Like you did it one time and it seemed like this. You should now trust me because I did it, which is the way that most gurus, they rely on anecdotal evidence, right? Like, I was really successful, so you should follow me because I was really successful, right? But we're talking empirical, which means that you can verify it yourself. You can run this against any data set if you have the data, and you will find that this property holds. If you go and you decide to trade 10,000 contracts or whatever out here and run it over a certain time period, and then you look at the volatility during that time period and the volume during that time period, and you know the why, and you'll find that and then you go and you do it again with twice as much, you're going to find that the impact that you have follows the square root law. Okay. And that square root law is a major factor behind why momentum works on day charts, but not intraday charts. Yeah. Now, I mean, when you're looking at a daily chart versus a 1 minute chart, I mean, there's many very clear and obvious differences, right? So the big one is if we look at volume, especially if you put volume on. Vol. Okay. Oh, that's a 5-minute chart. Okay, cool. Oops, not new window, new tab. Okay, so what do we see? Most of the volume is at the start and end of the session, right? What do you see when you go to 1 day? You don't see that, right? You don't see that. So just looking at the volume and the cycles that happen throughout the day, you could identify the difference between a daily chart and a 5-minute chart very quickly, right? Or saying empirical just means corroborated by evidence. It's different in the sense from something like anecdotal evidence. This goes deeper into things like science versus evidence-based. E.g., all the fund wants say, oh, don't day trade because no day trader made millions, which is so easily invalidated because there are day traders that made. You're right, yeah. If you say it's impossible to make money from day trading, then like that can very easily be falsified. That's true. Yeah. But what we can do is we can look at, everybody that trades, or we could do a more confined experiment, right? We could say, I think that this day trading method works, so I'm going to take 100 people and teach it to them, and then they're going to have it. They're all going to trade it, and we'll have them trade it for 5 years and see how they do over 5 years, right? I don't think that you'd ever be able to get anybody to participate in a study like that where they dedicate 5 years of their life to it, right? But then you would find that like almost all of them fell, right? I have empirical evidence that day trading works for some. Yeah, sure. But in this case, we're what we're talking about, like people's performance isn't really so interesting, right? We're talking about the market itself. How does the market itself behave, right? No, your claims are a hypothesis. You don't understand like what a hypothesis actually is, or like what a theory actually is. But it is a proven theory. It is, well, we don't call it a theory, we call it a stylized behavior. The square root law of meta order impact is possibly, with the exception of volatility clustering. So you know what I mean by volatility clustering, right? Like if we have a really big volatility day where the S&P 500 drops like 3 or 4% or something like that, the chances of us having another high volatility day the next day are much higher than it normally would be, right? Volatility clusters. That's probably the most proven behavior in markets because all of these options guys are taking advantage of it, right? That, and then the next one would be that implied volatility tends to be higher than realized volatility. That's the next most proven stylized behavior for markets. That basically people pay up because of the uncertainty, but what actually ends up happening, it tends to be less than what they were pricing. Okay. But then the next one after that is that the impact of a large meta order of size Q tends to follow a square root law with respect to the size of the order. And it's well proven. I mean, like, people have gone and run this across like millions of different data sets and they always get the same result. It's not proven. Stop saying this is a hypothesis. You may have some informed explanation, but you can't prove the why. Well, okay, so the stylized behavior that exists in markets, that's proven. I did not go into why does that happen. Why does that happen? That is something that is, like a why is much more difficult to prove. But we have gotten to the point where we're pretty darn confident what causes that. Mostly because, like, we had a bunch of different theories, and then we ran through and we were able to falsify all of them except for one. So why does it happen? The reason it happens is because of the order book. It is a behavior that is a consequence of the market microstructure. That the use of a limit order book results in this square root law behavior. And that's why running it in the cryptocurrency markets was so important. Because somebody might say, well, it's because, it's some established behavior that, like, the markets, everybody knows that it kind of tends to do that, and so people act in accordance with it, or has something to do with the way the institutional traders work or something like that. But that's why it's important that when we go into an extremely underdeveloped market, again, this was like Mount Gox that we're talking about, right? You still see the behavior. You'll see that behavior anywhere that a limit order book is in use. And so we're extremely confident that it is caused by the market microstructure. If that's what you're talking about. But the square root law behavior, Like, listen, if you have this opportunity where it's like, we know that after 10,000 contracts that the impact was this, and you want to say, now I use double and it's going to be double the impact, don't make that bet. You're going to lose that bet. So this is one of the most empirically established stylized behaviors of markets. Okay, so yeah, you want to link to more trading on. So the best data, the best source to learn about this stuff. There's a book called Trades, Quotes, and Prices, Financial Markets Under the Microscope. This is like graduate level reading. Okay, there's a lot of math. It's Cambridge University Press. Okay, like it's a graduate book. Okay, but they go into basically everything about the market that's basically proven. And they talk about the square root law a lot. Okay, we're going to claim that short time frames don't work, but then you must acknowledge that reading. Well, okay, so you're making too broad of a claim, right? So momentum strategies don't work on short time frames, right? Price on short time frames is mostly random. Okay? And that doesn't mean that you can't make money on short time frames, right? But the ways that we know of that you can make money on short time frames all involve factoring in something other than just the price, right? Like we include the price of another asset, right? Now we're doing statistical arbitrage, and we're arbitraging between those two instruments that we should expect to be relatively efficient and follow each other pretty well. And when they're not, there's an opportunity for arbitrage, right? So that's one way of doing it, right? There are also some setups that are based on order flow, right? The easiest one to explain would be catching the edge. So when you have the bid and ask, and if the ask was to get small enough, you can hit into it. You know, if there's only 50 contracts left and I hit into it with 50 contracts, then it's going to tick up, at least temporarily. And if I'm fast enough, I can make money just doing that, just catching the edge. And there are a lot of algorithms out there that do that, for instance, right? There are also some things that you can do when there is an iceberg there. You can kind of scalp a tick off of it. Okay, again, these are things that you have to be super, super fast at, right? So when we're reading order flow, we're looking at those things and kind of using what we're seeing to verify what we're looking at. Those are edges that we can't take advantage of ourselves, but can still inform our trading and can help us and make our trading more accurate, right? And there are things that you can see in the order flow that will kind of tip you off to that a large meta order that will create a short-term trend is coming into the market, right? And so if we have a way of predicting those orders, and then we start to see that evidence coming out in the volume that you're correct, and you can take a trade, and that's how we take trades, right? But momentum itself, and this propensity for markets to trend over long time periods, that specifically you need daily, weekly, monthly bars. It doesn't work on daily bars, right? And the whole reason why that was relevant is that that's something that we can kind of use that differentiates an intraday market from a longer term market. When you get to a longer term time frame, then there are more inefficiencies in the price itself that you could potentially take advantage of. Because momentum strategies, they rely almost exclusively on the price of the asset. Are you getting way too technical for the average retail trader? Well, I feel that the average retail trader's notions of how to trade and like what should work and what doesn't work looks so ridiculous when compared to the actually proven market behaviors. And once you understand the actually proven market behaviors, you kind of realize how most of the approaches that retail traders are trying to use to day trade are just going to fall flat on their face. Like the biggest thing here is that if all you have is the price history, it's just random. You're just gambling, essentially. You have to have something more than that. You have to be able to, even with the order flow, like there is stuff available in the order flow, but again, the things in the order flow that are like truly reliable are things that like only the robots are able to take advantage of, right? So the order flow can help us in that case, but that still can't really be the basis of our edge, right? We have to have something else. We have to have some piece of information that's going to tell us what the orders are going to come in as, that gives us an advantage over everybody else. Which means like you have to follow the news and like actually know what's going on and things like that, right? Most retail traders, their approach is, I don't want to know anything. I don't want to know what the news squawk is. I don't want to know who's reporting their earnings that day or any of that stuff, because I should be able to just look at the price. They got that from swing traders that were trading momentum. That works for swing traders that are trading momentum because they're looking over long time frames, and what happens on the news in the short term doesn't necessarily matter, right? But for a day trader, it's a different game. For a day trader, being able to react to a piece of news coming into the market right away is like one of your largest sources of edge. What was this? There is zero traders who have the tools and connection speed to an exchange to profit from arbitrage plays. Well, that's not true. There are definitely algorithmic trading firms out there that make money from arbitrage. And arbitrage combined with more providing liquidity overall is profitable. You have to have a really big wad and be able to take on a lot of inventory, but so essentially you either scope down and use multiple things, price trend, volume, order flow, options, magic, etc. Or you go price only, momentum, higher time frame. Yep. Now, I'll warn you, if you want to go price only, momentum, higher time frame, this is where this kind of thing that maybe you've heard this idea that like the reason the strategy works is because you manage risk, right? Well, that's where they're getting that from, because once you start doing that thing, now what you're getting into, like as I'm day trading, I only have one position on at a time, right? In a momentum strategy, you can have dozens of positions on at a time. You want to have multiple different positions on at a time. And now certain things start to matter. Like if I have a position in the 10-year treasury and I have a position in the 30-year treasury, well, I'm not actually properly diversified, right? Because these two things are so highly correlated. So I have to kind of do things. Okay, that one's like kind of a trivial example, but the Japanese yen, that's also highly correlated. So if I have a position in the 10-year treasury and I have a position in the Japanese yen, that's kind of a problem, because if something happened in the Japanese yen, I could lose on both my Japanese yen position and my 10-year treasury position. And so what you do is you manage your risk. You say, these two things are correlated, so I can't take as big of a position in them. I have to split them up or something like that, right? And so the magic in a momentum strategy becomes analyzing the different assets in your universe and deciding how much to put into individual ones, which is actually even more advanced than the stuff that we're looking at with order flow. So just in case you're thinking, oh, I should swing trade, that would be easier. Not necessarily. And on top of that, those strategies also need a lot of capital to really work well. Yeah, the retail trader on Ninja Trader 8 running orders through a retail broker doesn't have the tools or connection speed to profit off it. Probably. I'm not going to say that there's not. I've definitely seen people. I think one of the problems is that, like, just the opportunities for quote unquote arbitrage in futures in general are pretty limited. Like, the best arbitrage play that you can do in futures is going to be between the future and the underlying commodity, right? Like, I trade cash treasuries versus the futures, basis trading essentially, right? But in order to do that, you have to have enough money to hold a full contract in the, you know, like, if I'm going to do that in treasuries, one contract is equal to a $100,000 bond. So I have to have $100,000 at least, right, to do basis trading. So that's not most retail traders, right? But you can find ways to play that game if you get into options, right? Once you get into options, because there's so many different strike prices and all this other sort of crazy stuff, that then retail traders can find arbitrage opportunities. Yes. And I'm hoping, you know, I have some more writing to do, but I'm hoping to make a recorded video about this today, going into the different asset classes. And, you know, and that's one of the things, is that if you really want to be like quant stuff, there's probably more fertile ground for you in options, or especially if you want to do arbitrage. Whereas futures, I really feel that futures favor informed traders. This is why it's so funny that everybody wants to trade just off of a chart, and that the people that want to trade just off of a chart also tend to be attracted to futures, because they've been told that futures are much more technical. But the reason they were told that is because the most popular strategy in futures is momentum strategies. But you have to be swing trading. If you're day trading, it's a different thing. If you're day trading, favors the informed. So really, if you want to trade futures, I say that the most fertile ground for you is trading the news. So the treasuries have kind of come back to buyers or sellers cost basis, 19.5. Overall, the whole action today has me a little bit like off balance. I'm not sure if there's anything I can do with it. There was some volatility and everything, but the way it played out was pretty chaotic. You trade futures and forex simply because of the leverage I get. Well, and that's kind of one of the points that I want to make in the video, though, is that, like, a lot of people choose what instrument to trade based on one of two things. One is, what is the cheapest thing for them to trade, right? Like, I have limited capital, and so I'm going to trade futures because I can't day trade stocks because I don't have $25,000, right? That's one thing. And then the other thing is the thing that gives them the most leverage, which is why you see so many retail day traders trying to trade NQ. But the right way to go about this is to actually say, what is my best opportunity to actually develop an edge, to develop an advantage over other players that will lead to my success, right? And that requires you looking at yourself and looking at the resources that are available to you and playing an asset that matches that up the best. That's why it's like, if you really want to do like arbitrage kinds of stuff, do options. If you're going to do news, because one of the big advantages that I have is that I've just always read a lot of news. I've been very involved in politics. I've been very involved in economic news since I was a little kid. So I understand the news and how the market's going to react to the news really well. And so the most fertile ground for me is going to be in the futures and kind of trading macroeconomic news. Maybe your edge is kind of more knowing everything that's going on in a certain industry or in the stock market in general. And so you're able to identify what stock is going to be the best stock to trade that day. Then maybe it's best for you to trade stocks. And like, if you don't have enough money to get around the day trade rule, then just, have some days where you just can't trade, I guess, things like that. Because what the market does is they kind of herd you into losing games because you're too impatient to save up enough to be able to trade the way that you want. Yeah, great point. I switched from equities to bonds, metals, and energies. There's too much noise from everyone who claims to know what they're doing. Bonds are slower. Yeah. Well, and I mean, that's kind of like the broader thing is you really just can't, any person that's on the internet and they say market is X, if they're not providing empirical evidence, right? When I say something, I try to cite like the studies or where you can look these concepts up so that you can see that they're like actually proven, right? So like my whole thing is I'm trying to give you empirical evidence. If you find somebody on the internet and they're not providing empirical evidence, it's just noise. Like there's too much data for you to be able to sift through to be able to tell like, which advice these people are giving is true and what's not. In most of the cases, we're not going to be sophisticated enough to be able to prove them right or wrong anyways. So it's just noise. Everything that doesn't have empirical evidence is noise, in my opinion. It just so happens that I'm like the only day trading creator out there that talks empirical evidence. And the people that make the empirical evidence, they're not social media people. The more that I think about it, the more I'm like, you know what? Like the ideal person? Because like, why is it me? Why is it me that has this privilege? Well, the people that I think should do it, they wouldn't have that. They wouldn't have it. You're going to go into, university and advanced statistics, and you're going to go and you're working at a firm. You don't have the time or the resources to be able to play the social media game and get good at explaining things to people and understanding live streaming and how to produce a YouTube video and all those sorts of things, right? So it has to be me, actually. I'm the only one that actually has all of the pieces, it seems. Eventually, someday, a kid will come along and displace me, but found your channel when I switched to trading bonds. Oh, very good. Thank you very much. I sure do love the 10-year treasury. I think that people pass over it for like the wrong reasons. Like the things that people dislike about ZN are actually what makes it such a great asset to trade and what makes it so interesting. You just have to get away from the price moving up and down is the thing that drives my dopamine for the day, and move over to every level 2 change is actually the thing that drives my dopamine, right? Because the level 2 changes is actually like way more interesting to me. It's a lot more random too. Well, in some respects it's more random, and in some respects it's not, right? If you look at any one individual change in level 2 out there, yeah, just noise, right? So you're getting a lot of data to come through and occupy your brain, but then when you get down into like the stylized behaviors, you actually find that there are some very, very reliable behaviors that tend to be coincidence. So they might not have like a predictive signal, but especially in terms of like verifying your trade, very, very effective. Very, very effective at verifying your trade. Why do you do ZF and ZT overnight and ZN during the New York session? That's curious. I've always kind of found that trading the shorter term ones is kind of, I don't know, doesn't work as well for some reason. I don't know why, but I've always had the best success with the ZN. I started on ZB because it was like the thing. It was like, oh, well, that's the one that gives me the most leverage, so I better trade that one, right? No, bad idea. I mean, probably do better now, but I got destroyed so badly when I was doing ZB. I don't need empirical evidence to execute a profitable trade any more than I would require empirical evidence to do anything in life. Well, you don't. Obviously, you can take a trade without empirical evidence, but that you would have long-term success without empirical evidence, or even more so, that you would have long-term success in contradiction to the empirical evidence, very unlikely. Very unlikely. Case in point, like, can you show me a 5-year trading history? I've never seen it. I don't have it. I don't think I may not exist a retail trader. It might just not exist in retail trading. So we are crossing the buyer's line now, 21.5. So buyers are in control. S&P 500 is continuing to sell off, and that might be why. And we're getting a decent shift in cumulative delta as well. So I was not necessarily predicting that the S&P 500 would go down, but now that we're seeing that, that's probably just continuation of the momentum that we've had. Although I think that I need to pull up NVIDIA here because, you know, the market was kind of waiting for NVIDIA. So I want to see what that's doing. Okay. So here is the movement yesterday. It was actually quite mixed, but then in the end, they kind of bid up. And then in the morning session, it looks like that they bid it. And now as the S&P 500 is starting, they're almost selling it down to below the lows. So NVIDIA is following the rest of the market lower, or maybe the rest of the market is following NVIDIA lower. But that, I think, all speaks well for that it is a strong momentum kind of people piling on sort of a thing, which does mean that we could get, well, I've already spent way too long yapping about it because we would really prefer 21. Would really prefer 21, so it's already gone a little bit in favor. I could probably still get away with it at 23, but and I'm worried some of these metrics might not be accurate because of the data issues that I was having earlier. Do you think if I reload all data now that it will fix it? I don't know. And I'm not getting my trading algo is not getting anything. Oh, well, I'm worried about reloading the data that will screw this up, so let's not mess with that. I've been in my ZF trade since the Tokyo Open last. Oh, that's interesting. But then there's like that other thing, which is that like there are real advantages to swing trading, right? If you swing trade, I would expect that you would make money overall, but that you would underperform any kind of like reasonable benchmark that you would want to be trading, you know? But that's better than outright losing everything, which is what day trading usually results in, right? Okay. You keep mentioning news as help. I would disagree. The market routinely reacts differently off of a news drop that logic would dictate. Okay, so that's where the next key insight that you have to have. What we are trying to predict is orders. Not price, orders. Because there's so much noise in price. When we start looking at orders instead, now we have something that we can actually like do real data with and everything, right? So when you look at a piece of news, right, most people would say, okay, was the news good or bad? Okay, were earnings good or were earnings bad? Okay, well, earnings were like the highest that they've ever been. That's good. That should mean good for the economy. That should mean I buy the thing, right? That's kind of like a fundamental approach to things, essentially, as you're saying. That the fundamentals will predict the future price, right? But that's not what we want to do. We want to say, how will it affect the orders? So once we start working from that framework, we very quickly realize that you kind of have to have more information, right? And so the biggest one, and the one that I think most retail traders do know about, is that it's not about like whether it, like what makes it good or bad is what it was relative to the expectations, right? All of these analysts, they have an expectation about what these numbers are going to be. And, you know, so good or bad is actually, was the actual number higher or lower than what the consensus expectation was, right? So then you're going to get into this thing where it's like, okay, maybe we'll talk about jobless claims. That if jobless claims was lower than expected, then we would expect that to be good for the S&P 500, right? Well, okay, so again, we're trying to predict orders. And what are some things that predict orders? Well, one thing that predicts orders is like the money supply and what the Federal Reserve is going to do in the future, right? So that's where you can kind of get into these sort of contradictory moves where the jobs numbers are bad. That should mean that we sell, right? Because it's bad, especially if it was, you know, the expectation was worse than, sorry, the actual was worse than expected. Okay, less jobs created. So that should definitely mean that the S&P 500 sells, right? But then it buys why? Because what actually matters is the orders. And what that piece of news means is that interest rates will stay lower. That means there's more money out there. And more money means more orders. And so actually the market buys, right? So once you understand that, and there's other things like what is existing positioning, right? Like maybe it does come out better than expected, but everybody was already kind of positioned for it to be better than expected, right? Then it does the opposite of what you think it's going to do because everybody was already traded in it and they take their profits. Okay, but once you work from a framework of we're predicting the orders, all of those seeming contradictions you're able to resolve. Now, you might not understand all the time why you're getting the flows that you're getting at that time, right? But by the end of the day, I would say that 95% of the time, we have enough information from like reporters that are talking to the different desks out there and all of this sort of stuff. By the end of the day, we have a pretty good idea of what's causing it. What is driving those different flows. No. Well, but it's not really that things are already priced in, right? I didn't say that at all. So like a really good example is that there are some pieces of news that literally just cannot be priced in. So like you're expecting the Federal Reserve to do quantitative easing. Okay, so everybody's buying ahead of the Federal Reserve announcing that they're going to do quantitative easing. And so then you would think, okay, it should already be priced in. So when they do announce that they're doing quantitative easing, the market will actually sell because it was already priced in, right? But that's probably not what's going to happen in that situation, because the Federal Reserve is going to buy regardless of what the price is, right? Federal Reserve is going to buy no matter what the price is. And when the Federal Reserve buys, that will have an impact. Again, like all orders have impact, like we were talking about earlier in that square root law and everything else like that, right? Them buying, it's going to have an actual physical impact on the market. And they're literally telling you what they're going to do, and you can just front run it. And there's absolutely no way for the market to price it in, right? So it's not about are things priced in, it's about what predicts orders. So changing expectations. I thought that the economy was going to be like this, and now actually I realize that it's going to be like this. So changes in expectation about future fundamentals or future order flows does predict orders, but there's like a dozen other things that do too, and you have to kind of combine them all together and see what the net balance is going to be. Does NinjaTrader support other languages other than C# for algorithms? No. Not that I'm aware of. Okay, so come back to my line. So in that situation, I would expect it to form a liquidity hole somewhere. Maybe it is forming a liquidity hole at 22, but like that's way too far away from where it got at peak, which was 25. So this market is really not behaving normal. So I don't like this because, one, there seems to be enough volatility that we could go all the way back to 19.5, and I'm not seeing clear signs of a liquidity hole. But if we did see a liquidity hole, I think that at the moment, probably the best candidate would be 22. So that is like, I'll get in a position and it'll just go nowhere. Right, so I think in either scenario, it doesn't look very good for me, does it? It's a bit spastic. It really is. And I mean, it almost certainly is because that the market has been roiled by a pretty significant headline with Donald Trump reneging on when he'll put tariffs on Canada and Mexico and moving it back up to next week. Okay, well, it went up 2 ticks, but still at 22, so you have a chance to get in there if you wanted. So, you know what's funny is that I got 2 guys here in chat that seem relatively skeptical. And so, like, my first thought is, it must be that same guy that we were having issues with yesterday coming in and messing with us. But the thing that was so funny about the guy that we had yesterday is that he did not understand what we were saying at all. I don't know if he was even listening. So, like, we would say stuff and then he would make an argument that was, like, kind of showed that he didn't understand what we had even just said, because we had basically already addressed it. But the 2 that we got in here today are not doing that. They're actually making progressive arguments on it that, like, I'll explain something And I don't know, maybe they don't agree with it, but like, okay, so then they'll move on to, okay, like here's the biggest weakness in that kind of view of things. They're actually thinking here, because that would be, you know, especially this whole thing that like the fundamentals, the news doesn't really, like the market doesn't move in the way that the market should say that it does. Well, that is a really big flaw in like news trading, right? But we're actually, we follow the order flow theory of markets. So we actually have accounted for that. We've accounted for that bit, but it shows that they are thinking here. So I don't think it's the same person, or that same person was decided to step up their game. Okay. So I'm starting to get a little bit of a hint there at 21.5. No, it's still able to just go. Interesting. So like the market makers are showing liquidity, but they are all jumping out of the way, right? Every one of these ticks down, it's done so on less than 700 contracts. And it's actually a fairly significant drop. So see, this is remember what did I say? Like issue 1 is, if I take a long at 21.5, the market still seems slippery, so it can move against me very, very quickly. And option 2 is that there's a liquidity hole and it just stays there at 21.5. And what happened? We went down 5 ticks in less than a minute. So we read that one right too. And the problem with that is that is behavior that I would expect to continue to be a problem throughout the session. So it may just be we don't take any trades. But we'll see. Maybe the market order imbalance is able to get to that 60% level. It could happen. Right now, they're nowhere close. Uzi says, it's interesting how the market is a bit of a mess and the imbalance can't reach 60%. Yeah, it is. In other words, I think that we are getting like meta orders, but that they are both ways, right? So we don't have a clear imbalance. That would suggest, so this is the kind of a market. Well, the other thing that's interesting about it is that would be the kind of a market where I would think that a market maker would make a lot of money, right? But the market maker doesn't seem to be willing to add a lot of inventory right now. Probably because of the amount of volatility that we had. So yeah. Yep. Mess equals indecisive, no clear imbalance, just makes sense as well. Yeah. Except for, would we expect the order flow to be indecisive like that in this situation? Because I say no. I say that if Donald Trump is really going to impose tariffs on Canada and Mexico, that should really clearly hurt the markets in the short term and cause the treasuries to bid up. But they didn't do that. Like, that was the thing. It was immediately like, I have my prediction based on the piece of news, what the flows are going to be, and they did not match at all. So I didn't take a trade. The order flow verifying the trade part didn't work. So why is it so indecisive? that maybe the market doesn't really believe him. Maybe the market thinks that tomorrow he'll come back and say, oh, actually, we are going to delay it a month, right? I don't know. But chaos for sure. And I'm sure that most people that aren't used to this, didn't trade the Trump years, will be really frustrated. Really frustrated. Actually, look, here's a thread on Reddit right away. Trading in Trump's market sucks. The market is absolute trash. Everything is sliding while Trump strengthens ties with the worst nations on earth and alienates longtime allies. Every time he speaks, the market reacts negatively, and it feels like we're in a constant state of uncertainty. And uncertainty is definitely it. At this point, I think it's widely understood that negotiating with Trump in good faith is impossible. I don't know about that one, because everybody is negotiating with him in good faith right now. And so far, it seems that he's being quite successful. How does the U.S. market recover from this? Well, I don't think that much damage has been done yet. But so this is something that I was looking at yesterday. It's like when you look at the S&P 500, for instance, you know, well, this is just a retracement of where we were on election, right? This right here, this little trough right here is basically the few days before the election, and then this big jump is election day, election night, whatever, right? So we're not even below that. Kind of puts things in perspective, doesn't it? Yeah, like Democrats are causing consumer sentiment to come down. It's unclear to me to what extent consumer sentiment is just a leading indicator versus the thing that like actually causes things to go up or down, right? It's probably a little bit of both. But, you know, is it so bad that it's caused a recession and everything else, the uncertainty and everything? No, not yet. Not that much damage has been done. Not saying there's not a tipping point or anything, just we're not there yet. The pain trade and the weekly options are from 16 to 111 evens. Why don't you use the tick multiplier in ES? You know what? That's a good question. We changed it because we wanted to take a trade in it, wasn't it? And we never changed it back. Why don't we change it back? Because I do like the tick multiplier. I find it makes it a lot easier to read the S&P 500. Do you know when the new Jigsaw version? I don't. I haven't heard anything on that in a while. Hmm. Okay. I was looking at what is the year-to-date performance. So it was a 1.68. Okay. Or what it was at the top. Let's see here. Or did your robot? It hasn't taken a trade today. Did it not get? It got really close at 8 o'clock, but it does appear to me that there was never a strong enough imbalance for it to get in. If it had gotten in at that imbalance, because it was close, it would have been a fill, right? So very interesting. It never took a trade. And we got 30 minutes left, so I think probably it's not going to happen today.
Block sell.
Okay. That sell really seems to be coming out of nowhere, doesn't it? Do price jumps matter in volatility forecasts of U.S. Treasury futures? This is pertinent to my interests. Is price discovery in the Bitcoin spot or futures? The jury is out. Oh, that's interesting. So they try to determine where the price action originates, and they can't tell. That's interesting. Okay, this study investigates volatility forecasts in the U.S. Treasury futures market and emphasizes the importance of price jumps across the various maturities under moderate and sharp interest rate rising scenarios. We assess out-of-sample forecasting performance not only with statistical method, but an economic method based on volatility timing strategy. Our findings indicate that models including price jump specifications exhibit substantial enhancements in both evaluation methods over the entire out-of-sample period, particularly for the period of sharp interest rates rising. Our results are robust to non-parametric jump tests used in this study transaction cost and portfolio rebalancing method. All right. Some of that went over my head, but that is interesting. Then because it's about treasuries too, right? Oh man, I kind of was wondering what's going to happen here. There's that big order and everything, but we're already 3 ticks higher. So whoever sold is getting screwed over right now. Reset it again there. It is kind of so what I'm seeing, I think right now, is like the kinds of behavior that results in liquidity holes, but because the market makers are pulling everywhere, you're just seeing that everywhere, so it doesn't settle. So it kind of, oh, in fact, that's funny. As soon as I recentered it, I was like, I'm starting to see it at 20. Is it going to happen at 20? No, it didn't. They're still just moving around on like less than 400 contracts. I tell you what, man, this kind of gives me PTSD, because I think some of my worst trading was in a market like this. I think some of my biggest losses were in markets like this. And I haven't had any desire whatsoever to touch this. I don't know. And I haven't really seen you guys telling me about very many trades. Did any of you guys take something and make something? Because this is like a market that I've traditionally had very hard time trading.
All right. 1 minute. 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 1
Amir says he's out and chilling. I kind of wonder if maybe the reason that we're getting conflicting flows in the treasuries is like, okay, the news story was Donald Trump is moving up the date, changing the date again for when tariffs go against Canada and Mexico. So there was a pretty clear move in the dollar. There was a pretty clear move in the dollar, but there was not a clear move in the treasuries. And why might that be? Well, so one flow that we are going to see is flows following and or arbitraging with the dollar. But then I think another flow that you would see is, well, this is bad for the S&P 500, and so that means that interest rates can come down. So we buy the treasuries. That's probably one flow. But then probably another flow is, well, if he increases tariffs, that's going to increase the price of goods for end consumers. That's going to mean more inflation, which means that they can't reduce interest rates. They have to keep interest rates high to avoid creating inflation. So we would sell the treasuries. So I think that that's why we're getting contradictory flows. And the market maker doesn't know how to make heads or tails of it, so they don't provide any liquidity, and it just kind of slides around on practically nothing. Very dangerous market to trade. Any specific reasons for dropping in yields during the last 3 weeks? Oh my gosh, I'm sorry, I was yawning there. So I think that we can have a couple of different theories, but unfortunately, this is a situation where it's very difficult to disentangle and know for sure what is happening. A lot of people believe that policy uncertainty is hurting markets, and that is why we're getting the sell-off in equities, and the treasuries are just buying up because of that. But I think that it's a little bit more complicated than that. And the reason I would say so is when I come over here and I look at a longer term chart, just realize that, again, this is where we were at from the election. So after the election, there was a rally. Okay, there was a rally, and then, we've had this whole thing, but they recovered it. It was okay. So there's a lot of movement that we've had that I can't draw a straight line, but a lot of movement that we've had that maybe we're just going to give up. Maybe it was always overbought. You know what I mean? And then when I come over to the treasuries, it's kind of a similar story, right? Like, this is where we were at the election right here. Okay, so we're still well below where we were at the election. And there's still this whole thing right here, right? What's with this drop? That was basically the treasury market starting to realize that Donald Trump was probably going to win, was what that was, basically. So, I think that there is a strong argument to be made, especially in the yields, that the treasuries were already oversold anyways. And so this little bit of a move right here does not necessarily tell us a whole lot about like how the market is reacting to Donald Trump or where the economy is going overall. It could be just a soft spot that was always going to happen. It's going to take us more time to really know what's really the driving this. and or, you know, there's probably multiple things driving this, and maybe some sputter out and other ones keep going and are more dominant, right? So it's going to take a while for us to sort out. I'm seeing a lot of people kind of starting to talk recession all of a sudden. And, you know, I've been saying for a while, like, I think that the market is a lot weaker than the top line metrics suggest. But I never felt that it was enough to take us into a recession. So I still think that people kind of saying, oh, maybe we're going to have a recession, I still think that that's a little silly, right? I feel that the market is really coming down more into a more realistic understanding of the economy. Hiring has been slow. Firing a lot of government workers, that has a short-term negative effect on the economy. But the government was like almost all of the hiring in the last year anyways. So like the private market is actually really, really hurting. I really don't think that this economy can continue to go on the way that it is with the interest rates staying as high as it is, because it's the high interest rates are killing all of the white-collar, high-paying jobs. So that you will hold that long enough, that's definitely going to result in a recession. But that kind of says to me that the interest rates can't stay as high as they've been for very long, right? It's kind of interesting to me when the media gets interested in interest rates. There's a lot of times where I think they should really be interested in what the interest rates are doing, and everybody kind of ignores it. But that's not this time. This time it's like, that's like the question of the week. Oh, why are yields coming down? And I'm kind of like, you know, it's not really that big of a deal. Maybe I'm just a contrarian. I don't know. Yeah, kind of a self-enforcing feedback loop. Well, and so another thing is that like momentum is a thing that, well, especially once you start getting to like 30, 60, 90-day highs and lows, that triggers a lot of systematic strategies. So I do think that some of the action that you're seeing in the S&P 500 is technical. Like it's not the market reacting to Donald Trump or anything like that. It's just because, like, really, we haven't gotten that much this week. It's all been just this week, and this is like a no news week. And it wasn't until today that we really had super significant stuff. Okay, like some people will cite that we had consumer expectation news that was really bad. Well, yeah, but those news events usually aren't huge market movers. So I think that probably a lot of it is like what we call degrossing, which is like you're a long only fund and you have a lot of money invested in the market, and you say, actually, we don't think that necessarily that we're going into a recession or anything, but we do want to raise some cash, right? And we want to reduce our risk, and that seems to be what's happening, I think. And then when other people do it, it triggers momentum, and yeah, it becomes a self-reinforcing thing. So it's all technicals. It's all technicals. You'll see how long that lasts, right? Because it could be, yeah, we get technicals, but then maybe next week when we get the non-farms payroll, and then the non-farms payroll is really bad, and then the S&P accelerates, you know? Who knows? That's about the 20th time I've heard you mention. Well, I do really strongly believe that we need lower rates. There's much more evidence that lower rates lead to inflation rather than boost the economy. I don't know if I would put it that way. You know, like, because for the last 20 years or whatever, we've had interest rates at like practically zero, and we didn't get enough inflation, right? So, and in terms of it boosting the economy, well, now that actually is an interesting subject because, well, it does boost the economy, but it's lagged. It's very, very lagged. It seems to me that some of the Federal Reserve's other tools, like asset buying and stuff like that, has a more immediate effect on the market. You know? Yeah, if things get much worse, they're going to have to do asset buying if they want to, like, save the S&P 500 from going over the cliff or whatever the deal is, right? But the reason why I say that the rates are a problem is because tech companies can't hire anybody. They would need lower interest rates in order to be able to afford the debt to hire more people. Like, the math just doesn't work out. And so they are absolutely on hold. And I really don't think that you're going to get the tech market into a more balanced position without a lower interest rate. You know, so when I say we need lower rates, it's really a lot more of Seth needs lower rates, right? Seth needs lower rates right now. He really desperately does. Another thing that is going on that is related to this is that they changed tax rules in how you can expense development costs. That whereas before development costs were a cost that you could like a loss that you could carry over multiple years, now it doesn't work that way. And so that makes upfront development way more expensive, and therefore there's less people doing that. This is kind of why I made my conclusion that, like, I do want to make a platform, but it seems to me like the economic conditions are not very favorable to doing it right now. I would really have to have a significant group of investors to put the money into it, because otherwise taking a loan and having a few years of losses until we've fully built the application and everything, like, the business just wouldn't work, you know? Business just wouldn't work. So the higher interest rates really are having, we are in restrictive territory, and it is having very real damaging effects across the economy. And the problem is that we're kind of ignoring those because all of the top line numbers look good. But the top line numbers aren't actually as good as they seem. Now you're going to start to see that. And then maybe the market will start to shift into, okay, maybe we can continue to reduce interest rates until we get back to a neutral rate, right? How many cuts are being currently priced in this year? Well, last time I checked, one. But let's go look. I'll show you how to look. Okay, so if we go to cmegroup.com and we go markets, interest rates, and then at the top here, tools, and then we have CME FedWatch. Explore probabilities for FOMC rate moves, compare target ranges, or view historical rate data. And this basically uses SOFR to determine what the market is pricing. No, I don't want the pace of the roll tool. Okay, so now we have this little interface, and it's telling me, hey, the current target rate is 425 to 450. And it's telling me that for the March, that there is a 97% chance that they hold the rate steady, and a 2.5% chance that they cut, right? So remember, 425 to 450. So now let's go out to December. And what are they pricing in for December? 425 to 450, they say a 5% chance. Then a 21% chance of one cut, a 33% chance of two cuts, a 26% chance of three cuts. So that's actually very much changed. Now, a thing that we can do is we can say compare, and it will tell me what it was a month ago. So a month ago, or actually a week ago, the probability of us only getting one cut was much higher, almost 15% higher. there's a play off, and I understand there's a trade off, and there are times, so it was in COVID, where rates need to be lowered, and we'll deal with the inflation afterwards. But now's that out of time. But why would you say that? Because, I think that a lot of people got their jimmies in a rustle. Is that the correct phrase? On the last CPI report, because the CPI report was hotter than the consensus expectation. But all of the market analysts that I follow, at least, all said that it was going to be higher, and had been saying that it was going to be higher for quite some time, because the cyclical components of inflation were set to rise. So the cyclical components of inflation being set to rise is not really such a big deal. That is kind of something that's like, yeah, you deal with that for a few months and then it comes back down. So I don't see what is the data point out there that tells us that lowering interest rates really has a strong, would have a strong pull on inflation and really push inflation up. Because I see it as the opposite, that keeping the interest rates right now has a really strong probability of sending us into a recession if we keep them this high long enough. I think that if we had 2 or 3 rate cuts this year, that we're probably in okay territory. Yeah, and now the whole thing with COVID is really kind of interesting, because the data that we have now kind of suggests that, like, the initial asset purchases and the action by Congress matched what we needed at the time almost completely. And then what happened was the Federal Reserve kept rates easy for too long, like almost a year after they needed to. So even though the inflation overall was kind of caused by one third supply chain disruptions, 1/3 monetary policy, and 1/3 fiscal policy, the timing of that disruptions was different. And so really the party that actually made the biggest mistake was actually the Federal Reserve in not tightening interest rates much faster. That's super curious. That's the one that you probably aren't going to hear very, and people 10 years from now will still be arguing about it, but there's some empirical data about that I think really is really key. Or we're not anywhere close to a recession. Not yet. Yeah. Well, I earlier I said I think that the people saying that we're going to go into a recession. Yeah, I don't think so. But I do think that if we kept interest rates steady for, let's say, 18 months, if we kept interest rates where they were for 18 months, I think that would lead to a recession. Because like what we're getting right now, and the thing is, we haven't even talked about the government stuff, right? So it just as it was right now, we're seeing a pickup in hiring this month, and that bump tends to last until May-ish, is like when the most hiring happens, right? So how good does that get? And then do we go back into the later half of the year, things being absolutely atrocious, right? So I don't think that you can handle another 2 quarters of things being as bad as they were fourth quarter of 2024, right? That's where things kind of get nasty, because those are the spenders. Those are the people that really have the money to go out and do things and spend stuff and, like, really fuel that consumer spending economy. Then on top of that, you're firing all of these government workers too, who are also kind of in that section of, they have the disposable income. So yeah, it makes a dent. It really does. It's not like the end of the world, any one of those things on its own, but over a long enough period of time, that will result in a recession. And you're going to have to cut interest rates at a certain pace in order to resolve this kind of imbalance in the labor market and get people back to spending. Well, I don't think that they should be lowering interest rates like the last meeting or in March. That's true. But I would be upset if there weren't any rate cuts this year. I would, I don't think that this situation justifies it in January or March, and I wouldn't expect the Federal Reserve to cut in January or March. But for me, I would still really love to have that happen. It would be very beneficial to me. So if they could get it on with, I'd appreciate that. Screw the rest of the economy, okay? We need to worry about our people, John. Bob. His name is Bob. We need to worry about our people, Bob. Okay, so now that it's been a little bit, I do think that we see a liquidity hole. It's just like a really wide one, right? So I suppose you could market make across that. You could go from 19, between 19 and 19.5, maybe 20. Can we revisit the mishandling of the financial crisis by Bernanke and Hank Paulson? Yeah. Okay. What do you want? What do you want to say about that? You know, even the S&P 500 is kind of quieted down here now. Oh, actually, you know what? Maybe you should come tomorrow, because it is time for us to end the stream. I didn't even realize what time it was. Disappointed that our robot didn't take any trades today, but, you know, at the same time, I'm really proud of it. It's a good thing that it didn't take a trade, right? You think the market is coiling? I'm going to be looking for any kind of, information that helps me understand why Donald Trump is all of a sudden changing what he said just not even a few days ago, right? So there may be something going on with Canada and Mexico that pissed him off, or who knows what. I think that picking and choosing who did and didn't receive bailout funds was done without any foresight whatsoever. Well, yeah, it wasn't done with any foresight. Yeah, it really was like, we're not going to bail anybody out. And they went down that path and very quickly realized that that was a dumb decision. and then decided to go the other direction, right? I mean, are you suggesting that after we let Lehman and Bear Stearns and all of these other guys go under, that then at that point they should have said, well, we have to stick to our guns and just let the entire financial system get destroyed? There was a lot of people at the time that said, yes, that is what we should do. If you had asked me before the financial crisis, I would have said, yes, that's what we should do. But I think that the financial, I didn't really understand it that much about finance before anyways. I got involved in the markets and learned, and I very quickly realized that was an ideological view based on my politics that was impractical. That was maybe the first time that I came down into, oh, you know what? The world doesn't actually fit all of these neat little ideological boxes that we try and stuff it in. We have to be a little bit more practical. Because I don't like government coming in and making big actions like that, but I don't want to go into a depression, Okay, Bear Stearns got bought. Bank of America bought Merrill.
Block sell.
When Barclays wanted to buy Lehman, the Fed wouldn't back the move, and the Bank of England nixed the deal. That's true too. Or at least I do remember that. Although I'm not sure if that was entirely what nixed the deal, because I also remember all of this stuff with Lehman that was really kind of like, what the F were these guys thinking? Like, like Lehman had made this huge mistake, or possibly one of like the worst offenders, and then when they were trying to negotiate something, they were all trying to pull the wool over everybody's eyes. Oh, well, we're just gonna spin it off. Okay, sure. None of us are gonna buy that. No. You really think that we're gonna buy that one? Okay. Still remember, like, some of my first, like, quote-unquote day trades, although these were definitely sims, but like I remember one of the earlier ones was like about a year after all of that, because I just watched the market for a while, and then I turned into, oh, okay, I think I'm pretty good at this, let's do day trading. And like one of the first one was AIG just took off that day. Oh my gosh, this one was so freaking crazy. It was like, okay, it's like down for months, right? And then the next day, jump overnight, everybody picks up on it, and the price just goes like this throughout the whole day. And I was like, oh, okay, I'm gonna buy this. And I get out here, and I think it was just random. And as soon as I get out, whoosh, all the way down back to the low. And then it did this. And I've never since seen a chart that looked like that. that was a particularly crazy, and that was like my first introduction to it. And I thought I was a genius. It's like, see, I can tell. Yeah. Although, I also think with that, like the whole them nixing the deal and things like that, I think that there was a lot of political pressure at the time, right? Like, I think that was a part of why they were like all of a sudden like, oh, actually we can't do it in this way and things like that, right? Because I think it kind of started to turn into, okay, we can deal with this. But then people didn't like what they were doing, so they backed off, and then like things got really, really bad. And then after things got really, really bad, then all of a sudden everybody was willing to let them do whatever they want. Okay, Congress, we're going to get some money. The government is just going to buy it, etc., etc., you know? I remember the politics of it. You know, the thing that makes me sore about the financial crisis was that we made a bill to basically bail the banks out with public money. That's the thing that bothers me about it. Because the funds were there in the private market. And if we had just made a bill that like, you know, kind of organized the whole thing and gave certain benefits or whatever, but the money actually came from the private market, probably would have been a better way to do it. I think that the private market is better at that sort of a thing. And basically what happened was we used the government money, and then the government told everybody what it was doing every step of the way and didn't make nearly as much money as they probably could have made, like several times more money on like bailing out AIG in particular than they ever actually did. Or Citi was another one. Government practically owned Citi, and they got out too early and all of these other things. And I'm just like, I kind of feel like my tax dollars were wasted. That money could have gone back into the market to make other good investments, and it basically just went all into the pockets of the banks. Because the Federal Reserve just basically, or the Treasury basically told us everything that we were going to do, and so then the banks just front run it. I'd rather sign a line with the COVID loans that money should have been for small businesses without reserve capital, not to multi-million revenue companies that had STIPs to not pay back. Well, I mean, I don't remember the details about who could get a loan and who couldn't and stuff. Because I don't think that all of the large corporations necessarily did get them. There's a thing that is like, yeah, we did need fiscal stimulus. We absolutely did. So the question isn't, did we need fiscal stimulus? The question is about how did we go about doing the fiscal stimulus? It seems to me that program, what was the program called? I don't remember now. But it seems to me that those small business loans, that whole program, was very poorly designed. Very poorly designed, yeah. Was it TARP? No, because that was from the financial crisis. PPP. This is the PPP loans. Yeah. Seems to me that the PPP loan program was very poorly designed. Like, there was just so much fraud and abuse with that program that I really don't feel that the taxpayers got their money's worth. So I do think that you need fiscal stimulus, but you know, next time something like that happens, I would be advocating for a different way of stimulating the economy. What data feed do you use for ES? My CQG serves 2 to 3 different ticks different. Like the actual price is 2 to 3 ticks different. Well, so I am using tick aggregation. So I'm aggregating 4 ticks into one. That's probably why you're seeing that. Do you see how each level is only a point? So that's probably what that's about. But I do use a different data feed. I use Rhythmic data. Well, anyways, we were kind of talking. I really should get going, guys. Friday could be interesting. Next week is definitely going to be interesting because then we get real reports start coming through again. So I will see you guys tomorrow. Stay excellent, team.